why don't we get going? So this is Kirill Skok from Synaptic. I'm the host, and just to call out once more, if you have any questions during the meeting, then please send them to me via the chat, and we can answer those toward the end, or in case we don't have time, we can follow up with you over email. So thank you so much, everyone, for joining today. And I guess good morning to folks in the US, or good evening or good afternoon, depending on where folks might be dialing in from. Thank you so much for your time, and hope for me and the Synaptic team, sincerely hope you're staying safe, you and your loved ones. Given the time we find ourselves in, this is certainly quite a stressful and uncertain time for all of us, and this is a large theme for the call. Just FYI for those on the line, we will aim to answer questions toward the end of the call, and we are also recording the session in case anyone cannot make the full thing. So let's get going. Our webinar today is about recession-proof lending, and particularly serving your members better in stressful and uncertain time using machine learning and artificial intelligence. And as a quick introduction, my name is Kirill Skok. I'm a client engagement leader with Synaptic, and I have 10 years of financial services experience specializing in risk strategy and analytics, with a particular focus on credit risk. And we, Synaptic, we're a product company that brings the power of AI to credit processes. And we work with banks, credit unions, financial technology firms to help them make better use of data and make better decisions. So to start on our agenda, the world has changed quite a bit overnight, and we began preparing for this about a month ago, focusing on growth. And the kind of business challenges we were thinking of addressing is increasing approval rates to grow your member base, automating to support growth, as well as addressing, proactively planning for and addressing any kind of eventual recession. And the metrics for success that we thought about was the ability to serve more members more seamlessly, and being flexible and transparent about being able to plan. And of course, the world we find ourselves in today is quite a bit different from a month ago. And today there are new challenges with historic implications. And the new challenges that you might be looking to address with machine learning and AI is supporting your members and communities through an unprecedented period of stress, while preserving your members' capital to make sure that you will be there to invest in their recovery and support them on an ongoing basis. And so the new metrics are different as well. It's the existential impact for your core members, as well as the extent of financial backing you can extend within constraints of prudency. And so there's still quite a bit to talk about in terms of better underwriting, making better use of information. But the framing for the decisions you're making today is going to be pressured quite a bit by the environment we find ourselves in. And so what we've tried to do is to frame the use cases and the thinking about the work we have done and the insights we've drawn to this environment we find ourselves in, given that it's unprecedented and we need to make good decisions as quickly as possible, despite a lot of uncertainty. So at a high level, here are the 4 things we'd like to cover. And we can cover them all relatively quickly so that we have time for questions at the end. The first is the economic reality. I'm sure we all know where we are, but just to highlight how sudden, severe, and uncertain things are. The second is your challenge and how to navigate this tension between conserving capital and serving members' needs. And what we want to do is to provide an overall framework for thinking about the full range of decisions you might need to make. Then how AI and ML can help you make these decisions within particular areas. And then finally, thoughts on how to make AI more usable and how to manage any complexities to make sure that you can do so quickly and effectively. So first on the economic reality, we don't need to spend too much time here because I'm sure everyone is well aware of whatever is going on around us. But the first thing we wanted to show is, and again, these figures change day by day and week by week, but we have seen unemployment claims skyrocket very, very quickly at unprecedented levels. And similarly, the unemployment rate now has jumped up, but we know that your members and their communities are in very much the stress right now, and things so far have continued getting worse and worse, and more people are losing their jobs. And similarly, we see that among employees at small and medium businesses, given the stress that small businesses are under, those businesses are under stress themselves, and this is further adding to the stress for their employees. And so both your member businesses as well as your member individuals are under stress across the country, losing their jobs and in need of financial lifelines. And we see that although there is a range of impacts depending on industries, some industries are catastrophically impacted, others are, if anything, asked to step up much as yourselves for your communities, particularly small businesses, which we know you serve, are quite worried, under a lot of stress. And we see again here the world evolving. There were expectations that there will be a recession, but now we very much can be pretty confident that the recession is already here. And then the final point on the economic reality is that there is much uncertainty around what will happen. So depending on to what extent public health measures work, as well as what kind of economic interventions take place, it's easy to imagine many different scenarios for the recovery, from a more rapid to very extended recovery to, God forbid, things continuing to get worse for an extended period of time. And as a result, economic forecasts are similarly in quite a wide range, but what we see right now is very bad. So this is the environment we find ourselves in. And what we'd like to think about is how to help you better navigate this environment and make better decisions for your members. So on to your challenge as credit unions. At a high level, we see the challenge as a tension between your fundamental aims in this environment of stepping in to support members and conserving member capital. And we know that on the first point, this is something that credit unions as member-owned enterprises very much have in your mission to do. We know that during the last financial crisis, the credit unions often stepped in where banks did not, and supported your communities. And given the wide base of your membership, you're continuing to do so given how wide-ranging and universal the stress is. And things you might do to support that are drawing down excess capital to continue lending, trying to streamline member experience and help them manage their stresses, working with them on modifications and deferrals, and then getting ready once the recovery starts to lend into it. But of course, there's a tension with conserving your member capital and making sure that you continue to be viable until this crisis ends and out of it, which might mean decreasing underwriting to limit losses, cutting revolving lines, increasing collections capacity to cut costs and be more efficient. And so the question is, how do you navigate this tension, and how do you offer your members more and make their lives better while ensuring that you are managing their capital prudently and that you'll be there for them both through this crisis as well as into the recovery? And so at a high level, we think of this as a decision-making space with all of these actions that you can potentially take. And there's both a set of credit union specific dimensions, so your specific geographic footprint, the kind of members you have, their demographics and income, the kind of business sectors that you serve, that is very important, depending on, particularly, there are a number of credit unions that might be quite concentrated in geographic areas. There are a number that serve economically disadvantaged communities. These are all things that factor into your decision-making and what you can do. And similarly, the external environment, given all its uncertainties, we can imagine that right now there's a worsening crisis. Maybe we're starting to see a bottom, maybe there's not yet a clear bottom, but then eventually we will find ourselves in a trough and ultimately a recovery. And so the question is, how do you align your decision-making to all of these factors? So next, we'd like to talk about how we think AI and machine learning can help. So at a high level, this is a very broad view of what we think about when we talk about AI. And particularly, there's pattern detection based on the data that is fed in. There's the foresight to understand what is going to happen going forward coming out of this data. There's a lot of customization to make sure that whatever decisions you're making are suitable for you specifically to help you make better decisions and interact better with your customers. And here, both from a standpoint of greater efficiency and making sure you can cut costs and pass those along to your members, tailoring your members' experience, and making smarter decisions in this crisis period. All of these come into play right here and now. And of course, over time, there's also the matter of new value propositions, new channels, engaging with your members in new ways. But again, right now we find ourselves in more of a crisis. So it is about tailoring your interactions with members and making decisions to best support them right here and now. And so a couple of pages here on how we think AI can make you help better decisions in the here and now. The first is by integrating a wide range of data sources. So there are traditional data sources that we typically think of as being used for credit underwriting and planning, things like credit bureaus, as well as augmented data sources and things like additional application data, both what customers put on there, as well as things like their device IDs, where they are located, check writing history, customer views within your institutions. So all of this data provides a wide-ranging view of who your customers, who your members are, and what matters to them and how they behave. And so by incorporating additional data dimensions that might not have been used traditionally, we believe that you can draw better insights. So simply by expanding the range of data that you use, we think that by working with this data in a structured way, you can derive better insights. Of course, a lot of this data is both quite big in terms of size, as well as potentially quite a bit less structured often, and more difficult to work with than the traditional data sources that we're used to working with. And so one additional challenge is, how does artificial intelligence help us work with this data? And so very broadly, we think that the impact of the latest AI techniques is that there are an additional range of types of methodologies, which at a high level allow you to be more flexible and make use of more data with higher volumes and being able to deal with the potential anomalies and interactions within all of this data. AI models can ingest recent data much faster than traditional models, both in terms of being able to feed the data directly in and make quick changes, which again, should help reflect customer reality and reflect changes in that reality as quickly as those changes happen. Because these algorithms are much more flexible, it's possible to use a much wider range of predictors, again, making use of the additional data sources we've talked about above. And most critically, today we're at a point where AI models are fully transparent and explainable. So while there have been concerns, and we will discuss them some more down the line, about whether AI can be as transparent as the traditional linear statistical models that are commonly used for underwriting and credit decisioning, whether there are, we see now that AI is equally transparent and can be made so to satisfy a range of stakeholder requirements. How does AI do this? It's a matter of, first, segmentation. So making sure that you, depending on whether it's a new customer or an existing customer, what kind of borrower it is, for businesses, what industry segments they're in, the structure of the loans and the relationship themselves, that those are accurately captured, that you apply the right type of statistical techniques to derive hidden correlations and nonlinear patterns, to isolate any leading indicators that allow you to see into the future, and to make sure that you robustly use champion and challenger designs to make sure that the models are stable and that the insights are valid, and that any spurious correlations or signals are addressed. And coming out of that segmentation and statistical techniques, this allows you to make better decisions, both to approve loans, to decide on the amount of exposure, to manage your customers' limits, and to make sure that you segment the way you deal with your members appropriately depending on their needs. So what we wanted to do was, in a few pages, to try to make this a little bit more real. So rather than just talking about the data sources and the techniques, to talk about a few different case studies of work we've done and thinking we've done about machine learning and AI use cases for making critical decisions, and then to link those to the crisis environment that we find ourselves in. And so here, first, let's talk about sharper underwriting, then predictive collections use cases, forecasting, as well as sharper credit line management. So here is a case study on better underwriting, automation, and improved member experience for a leading credit union. And the business problem was a combination of a long time spent between application and funding, very legacy rules-based underwriting, and the need for automation to support growth. The solution was sharper pre-approvals, better data feeds, and the business impact was an increase in approval rates and reduced lending cycle times. But within this crisis, the key thing to highlight is, while growth and increased approval rates are not necessarily the immediate aim, given the crisis we find ourselves in, similarly applying AI to make better marginal credit decisions more quickly is important for making sure that you can deploy as much capital as possible to back your members while staying within the constraints of a prudent risk appetite. And so while the specific constraints on you and the timeframes and the what is being asked of you has changed, and it's less about growth and more about supporting the customers you have through these tough times, using the additional data sources, appropriately segmenting them, and deciding who are the least risky customers that you can deploy as much capital to as possible is critical in terms of being able to maximize your impact right now. The second case study is around actionable insights for early intervention and collections. And here the business problem again was simple, that there was a large delinquent portfolio and high collections costs. And there was high attrition from the portfolio after collections due to negative customer experience. And the solution to it was using a common data platform of traditional and alternative data sources to understand customers' preferences across multiple dimensions, and ultimately to maximize the impact of collections efforts, as well as reducing the cost, reducing delinquencies, reducing collection costs, as well as reducing customer attrition. And again, in this crisis that we find ourselves in, it will be important to limit your members' stress, even though collection efforts might be underway, while maximizing their impact to ensure that you can limit your losses and appropriately continue serving your members to remain viable and to direct funds to them where needed, while doing so efficiently in terms of being able to get things done and in terms of being able to limit those costs. And so again, there is a particular need where we find ourselves right now for smarter collections, for understanding what are your customers like, how will engaging with them lead to a most effective outcome, and accordingly making sure that you engage with them properly, recognizing and respecting the circumstances they find themselves in while achieving the appropriate outcomes. The third example is smart customer lifecycle management, where the business problem was high credit loss rates, and while wanting to maximize customer experience and value proposition. And the solution was underwriting risk models, as well as full lifecycle customer management, leveraging the customer's consciousness and preferences to be able to make decisions, assign credit lines, monitor early performance, decide on credit line increases and decreases, and ultimately maximizing customer retention. Again, increasing the level of approvals while preventing losses and increasing customer satisfaction. So this is something that, given your long histories with your members and given your understanding of that relationship, what you may want to do is to leverage that understanding and leverage the data you have on their preferences and on their behaviors to be able to most effectively engage with them, both to satisfy their needs as well as to make sure that from a financial standpoint, you're optimizing your risk profile and directing the funds where they can be most prudently invested. And then the last example is around better forecasting and planning, where the business problem was inaccurate forecasts that were quite volatile, and using traditional methods simply missed many nonlinear impacts. The solution was improved segmentation using AI models to generate better forecasts, as well as explicit macroeconomic linkages. The business impact here was, of course, increased accuracy of the forecasts. But where we find ourselves now, while the conditions we're in are unprecedented in the short term, and there isn't really too much historical data that can tell us what to do right now, as we look ahead into the recovery, as you decide how to time that, how to make decisions to optimize what you can deliver to your members as we come out of the crisis, and as you need to work with them to invest for the future, such improved planning is going to be critical to make sure that you continue to deploy limited resources in a prudent fashion. Oh, I'm sorry about that. Had a brief issue with muting. So the last thing we wanted to talk about, now that we've covered where we are, the challenges you face, and how AI and machine learning can help you address those challenges, is making AI usable given concerns about complexity and given the constraints we may have. And so again, starting at a high level, there are a number of barriers that many organizations face in adopting AI, from lack of clear strategy, lack of talent, to organizational and functional issues, lack of technological infrastructure, uncertainty on the methodologies, lack of data or limited usefulness of data, and overall, I think particularly as we think about institutions such as yours, technology infrastructure is a key one, and limiting the complexity of that, making sure that any AI solutions can be seamless and pre-packaged and all in one, making sure that everything can be transparent and explainable, allowing professionals to get comfortable with the results, comfortable with the methodologies. There are a number of potential limitations and potential roadblocks to implementing AI and making use of it to make better decisions, as we've discussed. In particular, given the financial regulation space, there are a number of regulatory constraints that need to be addressed. These include, first, adverse action reasoning, and making sure that any kind of AI models can be fully transparent, fully explainable, and fully documented, so that any decisions can be appropriately justified and appropriately communicated to customers, satisfying regulatory requirements. Around equal credit opportunity, models need to be compliant, and there need to be appropriate reports to ensure that there is no bias within the models, that there are no unintended impacts that nonetheless raise flags and potentially harm your members. So again, both in terms of transparency and in terms of the analysis of what's going on in the model, those need to be fully compliant. And finally, models need to be stable. So given the vast range of data and given the flexible techniques within AI models, there's a need for appropriate and robust validation, inferencing of what the performance might be of accounts that are not on your books, and regular monitoring and updates to models to ensure that once built, they continue to operate and that they make use of improved data quickly to remain accurate. And so this is something that we have thought about quite a bit that is critical. And while it's while it has been traditionally more complex to implement for AI, our focus has been to emphasize this transparency and emphasize stability and emphasize compliance with equal opportunity lending, fair lending, to make sure that that any concerns are addressed and that this is not something that folks need to worry about either on the business side or on the member side. So at a high level, how does this all work? So you're probably used to having a loan origination system that takes feeds of certain data to make decisions. And typically what we would see is an AI and ML credit underwriting system sitting alongside the loan origination system with data feeds across the two of them. And any data that goes into the loan origination system would then feed the credit underwriting system as well. Any additional data that gets put in could accordingly be slotted in, but the AI ML system provides a model score. It approves and rejects, and it provides any adverse action reasoning and feeds them back to the loan origination system, which then takes care of any downstream credit provisioning. But essentially, because of the number of moving pieces within the AI platform itself, we typically see it as a well-tuned package that sits to the side of the loan origination system and interacts with it seamlessly to be able to take the data, make appropriate decisions, and generate all of the necessary reports to ensure transparency and validity while feeding the decisions in real time. So here, this is how we see then the optimal end state of using AI to bridge your members, and regulators' expectations. It's taking in a wider range of data, developing solid analytics, and making sure that you use any kind of predictive features that can be leveraged. Using a robust platform to manage rules and strategies for how to deploy those features to make decisions, and integrating this with any existing LOS and other systems. Doing the decisioning in a way that is both robust, gives the right business outcome, but is also fully transparent and fully compliant with any kind of regulations, and continuing to monitor on an ongoing basis the performance of these decisions, both to ensure that you are fully comfortable with the outcomes you are seeing for your members, as well as to identify opportunities to use more data, to update the models, and to continue this virtuous cycle to continue to make better decisions. So again, to recap where we started. Initially, when we were thinking about this presentation and thinking about the use of AI and machine learning for recession-proof underwriting, we were thinking about a growth scenario and growing your member base, putting in the appropriate automation, and then planning for an eventual recession. The world around us has changed rapidly, and so we need to adapt. And so right now, you need to support your members and communities through this stress while preserving your capital. But you need to continue to make a similar set of decisions as before. You need to continue to lend and to extend a hand to your members while doing so prudently. You need to ensure a seamless and efficient member experience given everything else that is going on. And you need to plan for when a recovery comes, how do you best position yourselves to be there for your members in order to help them invest for the future? And this is something that we've discussed machine learning and AI can do through a number of use cases. Sharper underwriting that allows you to, at the margin, approve more customers by understanding who is most risky and who is least risky, deploying your resources in a prudent way that is nonetheless as impactful as possible. Predictive collections to prudently manage your losses while minimizing the stress put on your members, given everything that's going on. Accurate forecasting to be able to plan for when the recovery comes, how do you position yourself, as well as sharper credit line and customer lifecycle management to better understand, given what you know about your customer's relationship, what their needs truly are, and how within your constraints you can better satisfy those needs. So we're excited to be thinking about how do we best apply the techniques that we work with in a growth environment in today's environment, and how do we make a difference quickly. And so we're happy to talk about any questions folks on the line might have about these techniques or anything that we've covered. And if helpful, we are also more than happy to chat over email or set up some additional time to talk about specific questions you may have, given your particular institution's constraints and characteristics, how to help make better decisions using AI and machine learning. So as I mentioned in the beginning, if you have any questions, then please send them to the group chat. I will see them and then happy to answer them as best we can. So one question on the line was, why is it necessary to use moderate credit methods today? And I think if we turn to the one of our case studies where we looked at sharper underwriting, the example here is probably clearest, that by leveraging additional data and by using better features and better algorithms from that data to make credit decisions, you can greatly increase, for example, approval rates is what we tended to target within a given risk appetite. Or similarly, if risk appetite today is narrower, you can maximize whatever the risk appetite is that you're willing to take on at a given loss rate, what the approval rate can be corresponding to that. And so using traditional methods, you have a sense of differentiation of who the riskier members are, who the less risky ones are, and how to make the decisions there. Using a greater range of data and more flexible algorithms, you can have much more confidence in who the riskiest applicants are, who might exhaust your institution's resources, and who the generally much larger set is of quite safe applicants. And so as a result, this allows you to have more confidence in who is safe and who you can extend financial backing to, and as a result, maximize your impact. So thanks again, everyone, for joining. Appreciate your time today. And once again, hope you and your loved ones are all staying safe. If we're happy to answer any additional questions folks might have over email. And in particular, if you'd like to email me directly, please feel free to do so at it's first name dot last name, so kirill.skok@synaptic.com. And happy to talk about any other questions or perspectives you might have on the environment you find yourselves in, the kind of decisions that you see yourself needing to make, and the kind of data and analytics that might support those decisions. So thank you, everyone. It doesn't look like we have any more questions. Again, thanks so much for your time. And we will be in touch with you, and we hope to continue the conversation. Thank you.